In this video, we'll talk about how accountants interpret financial statements and evaluate the company's performance. Most companies use standard metrics and ratios to interpret and evaluate their financial statements, but there are certain metrics that are more unique to certain industries or the company itself. For example, new companies might be very focused on cash flow, a financial statement that you'll learn more about, and the related burn rate, the rate at which the company burns through its cash. In the healthcare industry, the term PMPM, or per member per month, is a common metric to evaluate how revenue and claims costs have changed month over month and year over year per insured member. In this video, we'll primarily focus on the financial statements for one accounting period and the related financial ratios. However, most companies compare the current period financial statements to prior periods to see how performance has changed. In addition, companies also compare the current period financial statements to the budget and forecast to understand where the results came in higher or lower than expected. Many companies also prepare income statements by legal entity, region, department, and even project to allow financial analysts to really understand the results. It becomes very interesting when you use data analysis tools like Tableau or Power BI, for example, to analyze results. Interpreting financial statements is the ninth step in the nine-step accounting cycle. What does it exactly mean to interpret financial statements? To interpret means to understand and explain the meaning and importance of something. And there are many people who want to understand the company's financial statements. For instance, the owners or managers of the business, but also investors, employees, creditors, customers, and tax agencies, because the financial statements help users make all kinds of decisions. Many accountants prepare a variance analysis worksheet before finalizing the financial statements. Here's an example of a variance analysis worksheet the accountant might prepare to review variances for quarter-to-date and year-to-date actuals versus the budget. Typically, the accountant would also add variance explanations for any variance above a certain threshold. Here I've used plus minus 10%, but in many companies, the variance threshold is a combination of a dollar variance and a percentage variance. For example, it might be a variance of $50,000 and 5%. In a separate column, the variance explanation is entered so that it is apparent that the accountant has looked at the variance, has an explanation, and there aren't any missing entries. In addition to a comparison to budget or forecast, the accountant also typically prepares a trend comparison by listing the past 12 months of a trial balance and analyzing whether any significant fluctuations exist, and then lists the explanation. So now let's talk about the financial statements. What we have here is Eli's Consulting Services income statement for the month ended December 31st. And the income statement can answer a lot of questions, such as how much did Eli's Consulting earn in net income in December? $33,667. How much would Eli's Consulting need to earn to cover all monthly expenses? $13,333. How much net income does Eli's Consulting earn compared to the revenue? That would be $33,667 divided by $47,000, or 72%. Or to say that another way, for every dollar that Eli's Consulting earned from customers, 72 cents was left after paying expenses. What were some of the largest expenses of the business? Salaries and rent expenses. Combined, those expenses are $12,000 and represent 90% of all expenses. What other questions could we ask? As accountants, it's important to make financial statements easy to understand for the users of those financial statements. In addition to looking at only one accounting period in future month, we would want to compare the monthly income statement the prior month and see how the expenses and the revenue differs. There are quite a few ratios that can be used to interpret the income statements. Some of the ratios are gross profit ratio, operating ratio, operating profit ratio, net profit ratio, return on investment, ROI, return on net worth, earnings per share, and book value per share. And some of these ratios only apply to corporations that have issued shares of stock. Next, let's look at Eli's Consulting's statement of owner's equity. Some of the questions we could ask are, how much did Trayton Eli earn on his investment of $100,000? To answer that question, we would take the net income for the period of $33,667 and divide it by the investment of $100,000, which would be 34%. So at this current rate of net income and assuming continuing net income at the same rate as December, how many months would it take for Trayton to double his capital? Our return on investment for December is 34%, so it would take about 3 months to double his capital, less what Eli draws out of the company. Another ratio that is used to interpret the statement of owner's equity is the shareholders' equity ratio. This ratio is expressed as a percentage and calculated by dividing total shareholders' equity by the total assets of the company. For Eli's Consulting, that ratio is 97.4%. That indicates that most of the assets are funded by stock rather than debt, and it also tells us that the company is financially stable. On the other hand, it could also indicate that the company is not effectively leveraging debt as a financing option. Let's now look at Eli's Consulting balance sheet. The balance sheet helps us answer a lot of questions about the company's assets, liabilities, and owner's equity. Ratios are very helpful in analyzing the balance sheet, and some of the key balance sheet ratios are the current ratio, quick ratio, debt to equity ratio, working capital, and the solvency ratio. So let's calculate the current ratio for Eli's Consulting. Eli's current assets include cash, accounts receivable, supplies, and prepaid rent for a total of $121,350, and its current liabilities include accounts payable of $3,500 for a current ratio of 34.6, which means that the company has plenty of current assets to meet its current obligations. Believe it or not, some well-known companies do not always have enough current assets to meet their current obligations. That doesn't necessarily mean that they're close to defaulting on their obligations, but it's worth taking a closer look at other ratios to understand why the company is so highly leveraged in short-term obligations. Although accounts are typically not responsible for the financial statement analysis, the financial analysts often ask the accountants why expenses are high or low, if there was unusual activity or other activity. In my experience, an effective accounting team will prepare financial statement analysis to ensure that nothing was missed during the accounting cycle and to have a ready answer for the financial and budget analysts. I hope that this video was helpful and you've gained additional knowledge about financial statement ratios and how accountants interpret and analyze financial statement information.